General auditing principles and auditor's responsibility. After studying this chapter, you will be able to understand the meaning of fraud and its characteristics, fraud risk factors with examples, gain knowledge of SE 240 auditor responsibility related to fraud and audit of financial statements, gain knowledge about SE 240 considering laws and regulations of audit of financial statement, learn about the finance significance in communication with job charge with governments about the SE 260 communication with both governments, and gain knowledge about 299 joint audit financial statements, gain knowledge of the SA 2402 audit consideration leading to the entity using service organization. Chapter overview. General auditing principles and auditor's responsibility. SA 240 auditor's responsibility relating to fraud and in audit of financial statement. SA 250 considering of law and regulations in audit of financial statement. SA 260 communication with those charged with governance. SA 219 joint audit and financial statements. SA 402 audit consideration relating to entity using service organization. See bio the auditor of the listed company listing 3 years at least company is in use of financial cycles of all the wrong reasons. They have alleged floating security contracts, rules of clandestinely controlling more than required percentage of shares in the mandatory rules. Besides, some companies being accusing of violation of other provision of security law. They are also alleging manipulating of share price, artificially keeping share prices high, and failure to disclose all related party transactions. The company is highly leveraged one. However, there have been no default in companies escaped in communication. Communication SEBI also sees a matter of their own matter of its own. Ever since about the allegation of 100 hurdle through media, auditor of the company is in a fix. Whether do such allegation reflect how do such proceeds in audit of ensuring a year regulatory report would tag teams and audit has been complained with the timeline. Audit of the 3 years has conducted in accordance with the standard of auditing is no wrongdoing as noticed and unmodified opinions exposed in the audit report. However, in the given current scenario, that is deemed to be a heightened level of audit risk. It is both foolish to him not take notice of such developments. The allegation of violation of the securities law, manipulating of share price, and failure to disclose all related party transaction would be a fraud risk factor. While fraud risk factors may not necessarily indicate the existence of fraud, they have often been present in circumstances where fraud has been occurred. Hence, there is an increasing risk of material misstatement due to fraud. One of the assessment of increasing risk of material misstatement due to fraud audit procedure has been designed to perform accordingly. Besides, both aspect of non-compliance of law and regulation may be material effect on financial statement. It would involve the hefty penalties and other issues. The management is not forthcoming to providing information relating to the complaints with laws and regulation does need to obtain legal advice. Whether it would also lead to any impact on its opinion, such the questions have stated him, staring him to face the current year of his tenure. If he accepts fraud involvement, management would be communicate this aspect to the audit and committee in discussing of this nature, timing, extent of audit procedure necessary to be complete the audit. General auditing procedure, principles, and audit responsibility. SA 200 is overall objective of an independent audit to conduct audit. Establish independent auditors' overall responsibility when conducting audit of financial statement according with the standard of auditing. Audit has to be planned and performed in professional skepticism SKEPTICISM recognized and that circumstances may exist that causes financial statements or materially misstated. Misstatement may arise from the error and fraud. SA 240 deal with the auditor's responsibility relating to fraud and audit of financial statement. Auditor may remain allowed throughout the audit, recognizing the possibility of audit material misstatement due to the fraud could exist. Entities are subject to various laws and regulations. Non-compliance of laws regulations may regulations may result in fines. Litigations of consequence of this entity leading to material effect of financial statement SA 250 leading to auditor's responsibility regards with performance of audit of financial statement. Since many laws and regulations affect entities, audit has to remain allowed the possibility of non-compliance with laws and regulation. Communication to those charged with governance a timely basis. During the audit serves many useful purposes. SA 260 deals with auditor responsibility in this regard. REGRD SA 209 details special consideration relating to the responsibilities of auditors in the joint audit. It is very common to the user these days to outsource activities from a third-party service organization. SA 402 develops upon the auditor's responsibility to obtain sufficient appropriate audit evidence in the suspect. SA 240 auditor's responsibility in relation to the fraud and audit of financial statement. SA 240 deals with the auditor responsibility relating to the fraud and audit of financial statement. It requires assess the auditor in identifying assessing the risk of material misstatement due to fraud and in designing procedures to detect such a misstatement. Objective of auditor in accordance to what is that identifying assessing the risk of material misstatement in the financial statement due to the fraud to obtain sufficient appropriate audit evidence about assessing the risk of material misstatement due to fraud through designing and implementing appropriate responses and to respond appropriately identifying subsequent fraud. Objective of auditor to identify and assess the risk of material misstatement in the financial statement due to fraud to obtain sufficient appropriate audit evidence about the assessed risk of material misstatement due to fraud through designing and implementing appropriate responses to respond appropriately to identified and suspected fraud. Meaning of fraud in this character: fraud is an intentional act by one or more individual among the management, those charged with governance, employees, third parties involved to use the deception DECEPTION to obtain unjust or illegal advantages. The mismatches in financial statement can arise from either fraud or error. The distinguishing factor between fraud and error is whether its underlying action that a result of the misstatement of a financial statement is intention or unintentional. Although the fraud is a broad legal concept, auditor is concerned with the fraud that causes material misstatement in financial statement fraud. The misstatement resulting from fraudulent financial reporting involves incentive or a pressure to commit fraud or a perceived opportunity, perceived PERCEIVED opportunity or some rationalization of act. The misstatement resulting from misappropriation of asset involves incentive or pressure to commit fraud or a perceived opportunity, some rational act. Two types of intention misstatements are relevant to the audit. Misstatement result from fraudulent financial reporting or misstatement resulting from misappropriation of assets. The fraud, whether due to misstatement resulting from fraudulent financial reporting or misappropriation of asset, involves incentives or pressure to commit fraud or deceiving perceived opportunity to do so. Some rational example: incentive or pressure to commit fraud. Financial reporting may exist when management under pressure for sources outside the inside the entity to achieve an expected and prescribed unrealistic earning target of financial outcome. Particular since a consequence of the significant management for failing to meet the financial goals can be significant. Similarly, the individual may have an incentive to misappropriate assets. For example, because of the individual as living beyond their means. A perceived opportunity to commit fraud may exist when an individual believes internal control can be overridden. From the example, because the individual is in the position of trust has a knowledge of specific deficiencies in the internal control. Knowledge individual may be able to rationalize committing a fraudulent act. Some individual possess an attitude, character, set of ethical values that allow them to knowingly or intentionally to commit dishonest act. However, even otherwise honest individual can commit fraud in an environment that imposes significant pressure on them. How fraudulent and financial reporting can be caused by entities. The fraudulent financial reporting involves intentional misstatements involving omission of amount or disclosure of financial statement to deceive a financial statement user. It can be caused by effect of management to manage earning in order to deceive financial statement user by influencing their perception as the entity's performance and profitability. Such earning management start out with a small action, inappropriate adjustment of assumptions, and changes in a judgment by the management. The pressure and the incentive may lead these actions to increase the extent that they result in fraudulent financial reporting. Such situation could occur when due to pressure to meet the market expectation or desire in the maximum compensation based on performance management intention taking position that leads to fraudulent financial reporting by materially misstating the financial statements In such entities, management may be motivated to reduce earning by material amount to minimize a tax or inflate the earning to secure banking financing. The financial transaction, fraudulent financial reporting may be comprised of following manipulation, falsification, including forgery, alteration of accounting records or supporting document from which financial statements are prepared, misrepresentation of intentional omission from the financial statement of the events, transactions, or significant information, the intentional misapplication of the accounting policies regarding the relation to the amounts, classifications, manner, presentation, or disclosure. Fraudulent financial reporting often involves management override the control, otherwise may appear to operation effectively. Fraud can be committed by the management overriding the control using a technique as recording fictitious journal entries, particularly close to the end of financial period, to manipulate the operating result to achieve other objectives. Inappropriately adjusted assumption and changing judgment used to estimate account balances, omitted, advancing, or delaying recognition of financial statement of the event and transaction that have occurred during the reporting period, cancelling or not disclosing the fact that would affect the amount recorded in the financial statement, engaging complex transactions that are structured to misrepresent the financial position or financial performance of the entity, altering records and terms relating to significant unusual transaction. How misappropriation of asset can be accomplished by entities. Misappropriation of asset involving theory of theft of an entity's asset often pretend by the employees in relative small immaterial amount. However, it can also involve management who is usually more able to disguise or conceal the misappropriation in a way that is difficult to detect. Misappropriation of asset can be accomplished in various ways, include embezzling receipt. For example, misappropriation, collection of account received, or diverting receipt in respect of return of accounts to personal bank accounts, stealing physical asset or intellectual property. For example, stealing inventory of personal use or for sale, stealing scrap for resale, colluding with the competitor by disclosing technical no data in date return of payment, causing the entity to pay goods and service not received. For example, payment to the fictitious vendor, kickback paid by the vendor of the entity's purchasing agent, return for the inflated price, and payment to fictitious employees, using the entity's asset for personal use. For example, some entities assets are collateral for personal loan or loan to a related party. Misappropriation of asset is often accompanied by false or misleading returns or documents in order to conceal the fact the assets are missing or have been pledged with proper authority. Although the auditor may suspect a rare case identify the occurrence of a fraud, the auditor does not make legal determination whether the fraud has actually occurred. The primary responsibility to prevent and detect fraud. The primary responsibility for preventing and detecting fraud rests on both the charge with the government of the entity and the management. It is important that the management with the oversight of charge of the governance place a strong emphasis of fraud prevention, which may reduce opportunity for fraud to take place, and fraud deterrence. DETERRENCE deterrence, which would persuade individuals not to commit fraud because the likelihood of detection and punishment. This involves commitment to creating a culture of honesty, ethical behavior, which may be reinforced by an active oversight by this charge with governance. Responsibility of the auditor. The auditor conducting an audit in accordance with the standard of auditing is responsible for obtaining as a reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. Owing to an inherent limitation of an audit, there is an unavoidable risk that some material misstatement of financial statement cannot be detected, even though the audit is properly planned and performed in accordance with standard of auditing. The potential effect of inherent limitations are particularly significant in the case of misstatement resulting from fraud. The risk of not detecting material misstatement resulting from fraud is higher than the error is not detecting one resulting from error. This is because the fraud may involve sophisticated and carefully organized scheme designed to conceal it, such as forgery, FORG, or forgery, deliberate failure to record transaction, intention misrepresentation being made to the auditor. Such attempts to concealment may be even more difficult to detect when accomplished by collusion. The collusion may cause the auditor to believe that audit evidence pursue when it is in fact it is false. The auditor's ability to detect fraud depends on the factors such as skillful of the perpetrator PERPET RAT or PERPET or frequency and extent of manipulation, degree of collusion involved, relative size of individual amount manipulation, and the seniority of the individual involved. While the auditor is able to identify potential opportunity for fraud to be pertained, it is difficult for the auditor to determine whether the assessment misstatement is judgment received in the accounting estimates is caused by fraud or error. Furthermore, risk of the auditor is not detecting the material misstatement resulting from the management fraud is greater than the employee's fraud because the management is frequently in a position to directly indirectly manipulate accounts records, present fraudulent financial information, override the control procedure designed to prevent similar fraud by other employees. When obtaining reasonable assurance, auditor is responsible for maintaining professional skepticism skepticism throughout the audit, considering the potential for management override of control, recognize the fact that audit procedures are effective detecting as may be effective for fraud detection fraud. What is a fraud risk factor? The fraud risk factor or events or conduct that indicate any incentive or pressure to commit or provide opportunity to commit for example need to make expectation of a third person to obtain additional equity financing may create pressure to commit fraud. Granting significant bonus if unrealistic profit targets are met and create incentive to commit fraud. The controlled environment that are effective way creating opportunity to commit fraud. For example, the fraud risk factor. The following are example of fraud risk factors. Opportunity to commit fraud. Example of fraud risk factor. The following are the example of fraud risk factors. Relation to misstatements arising from fraud financial reporting or from misappropriation of asset respectively. Risk factor relating to misstatement arising from fraudulent risk reporting. The following are the example of risk factor relating to misstatement arising from fraudulent risk reporting. Incentives pressure. The financial statements or financial stability or profitability is threatened by economic, industry, entity operation conditions such as indicated by high degree of competition or market saturation accumulated by declining market, high vulnerability of rapid changes such as changes in technology, product obsolescence or interest rate, significant decline in customer demand, increase in business failure in either the industry or overall economy, operating losses making the threat of bankruptcy, foreclosure, hostile takeover imminent, a recurring negative cash flow from operations or an inability to generate cash flow from supplies either reporting and earning growth, rapid growth or unusual profitability especially compared to the other companies in the same industry, new accounting statutory regulatory requirement, excessive pressure exerted by the management to meet the requirement or exception of third parties due to the following: the profitability at thread level, exception of investment analysis, institution investors and significant creditors or other external parties, the particularly exception that are undue, aggressive, unrealistic, including exceptional created by the management in, for example, overall overlay optimistic pressure, real releases in annual report passages, need to obtain additional debt or equity financing to stay competitive, including financing major research and development of capital expenditures. Marginal ability to meet exchange listed requirement, debt repayment, other debt conversion requirement. The presumed to real adverse effect of market poor financial result on significant pending transactions. Such business combinations and contract awards. Information available indicate that personal financial situations of management on those charged with governance threatened by the entity's financial performance arising from the following: significant financial interest in entity, significant portion of its compensation, for example, bonus, stock options, earn-out arrangement, being contingent upon achieving aggressive target for stock price and ongoing and operation result, the financial portion of the cash flow, personal guarantees of debts by the entity. There's excessive pressure on the management operative person to meet the financial target established by the charge of governance, including sales or profitability and incentive goals. And we can add increasing the tax opportunities. The nature of the industry or an entity's operation provide opportunity to engage fraud and financial reporting that can arise from following: significant related party transaction not in ordinary course of business or with related entities not audited by another firm, a strong financial presence or ability to dominate certain industry sector that allow the entity to dictate terms and conditions to supplier or customer that may result in inappropriate non-arm length transactions. Assets, liabilities, revenues, expenses based on a significant estimate that involves subjective conditions of uncertainty that is difficult to corroborate. COROBORAT. Significant, unusual, high complex transaction, especially those close period end of the post difficult substance over form questions. Significant operation located or conducting cross international borders and jurisdiction where a diverse business environment and cultural exist. Use of business intermediate for which there appears to no clear business justification. Significant bank accounts or subsidies of branch operations, the tax havens jurisdiction for which there appears to no clear business justification. General auditing principle, monitoring of management. Monitoring of management is not effective as a result of following: domination of management by a single person or small group in a non-owner managed business without compensation control, oversight of this charge of the governance over a financial reporting process and internal control is not effective. This is complex and unstable organization structure is effective by following: difficult to determine the organization or individual that has controlling interest in the entity. Over complex organization structures involve unusual legal entities and managerial lines of authority. High turnover of senior management, legal counsel, and those charged with governance. Internal control components are deflect. The result of inadequate control component deficiency result of following: inadequate control monitoring of control including automated controls and control over internal financial reporting, whether external reporting is required. High turnover rates or employment of accounting, internal audit, information technology staff that are not effective. Accounting of information systems that are not effective, including situation involves significant deficiencies in internal control. Attitude, rationalization, communication, implementation, support, enforcement of entities' value or ethical standard by the management, or the communication with inappropriate values of ethical standard that are not effective. Non-financial management, excessive participation in preoccupation with the selection of accounting policies or of the determination of significant estimates. A known history of violation of securities law and other law of regulation or claims against entities in senior management or those charged with governance, alleged fraud or violation of laws and regulation. Excessive interest by the management in maintaining increasing the entity's stock price or earning trends. Practice by the management of committing to analytics and analysts, creditors, and other third parties to achieve aggressive unrealized forecast. Management failed to remedy known significant deficiencies in internal control on timely basis. An interest on the management in employing inappropriate means to minimizing reporting earning for tax motivation reasons. A low morale among senior management. The owner manager makes no distinction between personal and business transactions. Dispute between shareholder in the close held entities. A recurring attempts by the management to justify the marginal inappropriate accounting on basis of materiality. A relationship between manager and the current and predecessor auditor in strain as exhibit as following: frequent disputes with the current and predecessor auditor on auditing and follow and reporting matters. Unreasonable demand on the auditor, such as unrealistic time constraint regarding completion of audit or issuance of report, restriction of auditor that inappropriate limit access to people or information, or access limit to ability to communicate effectively with those charged with governance. Domineering, domineering the management behavior in dealing with the auditors, especially involves attempts to influence the scope of the audit work or on selection or continuance of personal assistance to consumed on audit engagement. The risk factor relating to the misstatement arising from misappropriation of asset. Following are the example of risk factors relating to the misstatement arising from misappropriation of asset. Incentive and pressure. The personal financial obligation may create a pressure on management employees with access of cash, other assets susceptible to theft, inappropriate those assets. Adverse relationship between the entities and employees to access the cash and other assets. Access that are susceptible to thefts are motive to say employees and misappropriate assets. For example, the adverse relationship may be created by the following: known or anticipated future employee layoff, recent anticipated changes in the employee's compensation and benefit plan, promotion and compensation, other reward inconsistency with exceptions. Opportunity. Certain characteristics of circumstances may increase the suspectability of asset to misappropriate. For example, opportunity to misappropriate assets increased when there is a following: large number of cash in hand, inventory items that are small in size, high value, high demand, easily convertible assets such as beer, bonds, diamonds, computer chips, fixed assets that are small in size, marketable, lack of observable tech identification and ownership. Inadequate internal control over assets or may increase the susceptibility of misappropriation of those assets. For example, misappropriation of asset may occur because there is a following: inappropriate segregation of duties or independent checks, inaccurate oversight of senior management expenditure such as travel and other reimbursements, inadequate management oversight of employees responsible for asset. For example, inadequate supervision and monitoring of remote locations, inadequate job application screening of employees with access to assets, inadequate record keeping with the respect of assets, inadequate system of authorization and approval of transaction, for example of purchasing, inadequate physical safeguard over cash, inventories, investment, fixed asset, a lack of complete timely reconciliation of asset, lack of timely and appropriate document transaction, for example credits for merchandise return, lack of a mandatory vacation of employees performing key control functions, inadequate management understanding of information technology which enables information performing employees to perpetuate misappropriation, inadequate access control over automated records, including control over review of computer systems and event logs. Attitudes and rationalization. The disregard for the need of monitoring or reducing the risk relating to misappropriation of asset. The disregard of the internal control over misappropriation of asset for overriding existing control or by failing to take appropriate remedial action on the deficiencies in internal control. The behavioral incentive indicates risk displeasure or dissatisfied with the entities on the treatment of the employees, changes in behavior of lifestyle that indicates assets has been misappropriated, and tolerance of petty theft. Why evaluation of fraud risk factor by auditors necessary? Auditors should evaluate whether one or more fraud risk factors are present. While fraud risk factors may not necessarily indicate existence of fraud, they may often present in circumstances where a fraud has occurred and thereby may indicate the risk of material misappropriation of fraud. The fact that fraud is usually concealed may make it more difficult to detect. Nevertheless, auditor may identify the fraud risk factor. Fraud risk factor cannot be easily be ranked in order to important. Significant of fraud risk factors and necessary widely. Some of the factors will present entities within specific condition do not present the risk of material misstatement. According to the determination whether risk factor fraud risk practice present and where it is considered as assessing the risk of material misstatement of the financial statement due to the fraud requires the exercising of professional judgment, maintaining professional skepticism. Auditor may maintain professional skepticism throughout the audit, recognizing the possibility of material misstatement due to fraud must can exist. Notwithstanding auditing past experience to honesty, integrity of the entity's management, those charges governance. Unless the auditor has believed to reason to believe contrary, auditor may accept records and documents as genuine. If conditions identified during the audit course of audit believe that documents may not be authenticated or the terms in the document have been modified but not disclosed to the auditor shall investigate further. While response to inaccuracy, management of those charged with governance are inconsistent, the auditor shall investigate the inconsistency. Discussion among the engagement team. Wait. Discussion among the engagement team. The discussion among the engagement team shall place particular emphasis on how where the entity's financial statement will be spectacle to material misstatement due to fraud. Disregard of the need of monitoring and increasing and reducing the risk of material relation to misappropriation. Disregarding the internal control over misappropriation of asset or overriding existing control or fall in the appropriate remedial of deficiencies in internal control. Behavior indicates a displeasure and satisfied. This discussion shall be notwithstanding the managed engagement team members believes the management was charged with governance and honesty and the integrity. Risk assessment procedures are related action that that geared towards obtaining information for use of identifying risk of material misstatement while performing the risk management procedure and relating the activities to obtain and understanding the entities of its environment, understanding the entity's internal controls. Auditor shall perform procedure to obtain information for use of identifying the risk of material misstatement due to fraud, like inquiry of the management other than the entities, obtaining understanding of how those charges governance, exercise oversight the management process for identifying and response to risk of fraud in the entities. Internal control management has established to mitigate this risk of evaluation of unexpected relationship identified in performing analytical procedure which may indicate the risk of material misstatement due to fraud. Besides the discussed earlier, auditor shall evaluate whether the information obtained from the other risk assurance perform procedure related activities performed indicates one or more of the fraudulent risk factors are present. Response to assess the risk of material misstatement due to fraud of financial statement. In determining the overall response of assessing the risk of material misstatement due to the fraud of financial statement level, auditor shall assess the supervised personnel take, taking account of the knowledge, skills, and ability of individual to give significant engagement, responsibility, auditor assessment, and risk of material misstatement due to fraud and error. Evaluate whether the selection and application of accounting principles of the entities, particularly these relevant to subjective measures and complex transactions, may be indicative of fraudulent framework reporting and resulting from management effort to manage earning. Incorporate an element of unpredictability in the selection of the nature, timing, extent of audit procedure. Audit procedure. An auditor shall design and perform the audit procedure whose nature, timing, extent, or response to the assessed risk of material misstatement due to the fraud and assessment level. In doing so, auditor may change in time, nature, timing, extent of audit procedure to obtain audit evidences that is more reliable and relevant to obtaining additional corroborative evidence. For example, auditor identifies that management is under pressure to meet the earning expectation. There may be a related risk that management is inflating the sales by entering into sales agreement that include terms that preclude revenue recognition or by invoicing sales before delivery. In this circumstances, auditor may, for example, design an external confirmation not only to confirm the outstanding but also confirm the details of sales agreement, including date, any right of return or delivery terms. In addition to auditor might find an effective to supplement such external confirmation with the inquiries of non-financial personnel in the entities regarding any changes in sale agreement and delivery terms. Audit procedure responds to a risk related to management oversight control. Management is a unique position, but perpetuate a fraud because of the managing ability to manipulate accounts record and prepare a few fraudulent financial statement of overlying controls that otherwise appear to be operating effectively. The risk is present in all entities. Due to the unpredictability we in overriding the audit occurs, it is a risk of material misstatement due to fraud as a significant risk. Irrespective of the auditor's assessment of risk of management overriding control, the auditor shall design the performing audit procedure to test the appropriate journal entries recorded in the general ledger, other adjustment made in preparing a financial statement. It review the accounting estimate and basis of the evaluation of the circumstances and basis in the and representing a risk of material misstatement due to fraud. For significant transactions that are outside the norms course of finance business entity or otherwise appear to be unusual given the auditor's understanding of the entities and environment of other information obtained during audit. Auditor shall evaluate whether the business rational and the transaction suggests that may be given enter into the engage in fraudulent transaction or conceal misappropriated assets. The auditor shall determine whether, in order to respond to identifying risk of management, override the control auditor need to perform other audit procedures additional to specified in above. Evaluation of audit evidence. Auditor shall evaluate whether analytical procedures that are performed when forming an overall conclusion as to whether financial statements are a whole are consistent with the auditor's understanding of the entities and environment indicate previously unrecognized risk of material misstatement due to fraud. In order to identify a misstatement, auditor shall evaluate whether such a misstatement is indicative of fraud. If there is such indication, auditor shall evaluate the implication of misstatement in relation to such aspect of audit, particularly reliability of our manager representation and recognizing the instance of fraud relating to the isolated occurrence. If the auditor identifies misrepresentation, whether material or not, auditor shall reason to believe that it is maybe result of fraud of the management. In the particular senior management is ever it's involved, auditor shall re-evaluate the management of the auditor material misstatement due to fraud and resulting of impact on the nature, timing, extent of audit procedure, response to the audit risk. Audit shall also consider the circumstances or condition indicate possible collusion involves employees, management, third parties when recognizing the reliability of evidence and previously obtained. When the auditor confirm that is unable to conclude whether the financial statements are materially misstatement or record result of fraud, auditor shall evaluate the implication of the audit. Circumstances auditor is unable to continue the engagement. If it is a result of misstatement resulting from a fraud or suspect of fraud, auditor encounter an exceptional circumstances being into question the auditor's ability to continue performing the audit. Auditor shall audit and unable to continue the audit engagement. Determine the professional legal responsibility applicable in circumstances, including whether there is a requirement of the audit to report the person who make the audit appointment or such cases to regulate the auditors. Consider whether the appropriate to withdraw from the engagement, whether withdraw from the engagement is legally permitted. If the auditors withdraw, discuss with the appropriate level of management those charged with governance, the auditor withdrawal of the engagement and reason for the level. Determine whether there is a professional legal requirement to report to the person or a person who is making an audit appointment, or in some cases the regular authority of auditors withdraw from the engagement, reason for that withdrawal. Management representation. Auditor shall obtain written representation of management, those charges are applicable, those charges governance. They acknowledge they are responsible for design, implementation, and maintenance of internal control to prevent detection of fraud. They are disclosed auditor disclose to the management resulting they have disclosed to the auditors result of management assessment of a risk that is a financial statement that may be materially misstated as a result of fraud. If they have disclosed to the auditors in knowledge fraud or suspected from fraud effective the entities involving matter, employees who have significant role in internal controls other those fraud could buy material effect of financial statement. They have disclosed to the auditor their knowledge of the allegation of fraud or suspected of fraud effective to entity's financial statement communicated by the employees, former employees, analysts and regulatory authorities. Communication with the manager and those charged with governance. The auditor has identified the fraud, has obtained information and indicate the fraud may exist. The auditor may communicate the matter timely basis. Timely basis exist matter on timely basis in the appropriate level of management in order to inform them the primary responsibility for the prevention or reduction of fraud is matters relevant to their responsibilities. Unless all those charged with governance are involved, the managing entity, the auditor has identified suspect of fraud and involving management. Employees who have significant role in internal control other than fraud resulting in material misstatement in the fraudulent financial statement. Auditor should communicate the matter to those charged with governance and timely basis. If the auditor suspects the fraud involving management, auditor shall communicate those suspicion to those charged with governance and discuss the nature, extent of audit procedure necessary to complete the audit. Auditor shall communicate with charged with governance and other matter related to the fraud, that is auditor judgment relevant to these responsibilities. Communication to regulatory and enforcement authorities. If the auditor has identified a suspect of fraud, auditor shall determine whether there is a responsibility to report an occurrence or suspension of fraud party outside the entity. Although auditor's professional duty is to maintain confidentiality of the client information may preclude such reporting, such auditor's legal responsibility may override the duty of confidentiality in some circumstances. For example, in the case of audit of banks, auditor shall have central duty to report the occurrence of fraud to the supervisory authority of RBI. Also, in some entities, the auditor may have a duty to report misstatement to authorities. Then those causes the management, those charged with governance fail to take corrective action. In some clients, a requirement for reporting fraud were not discovered through the audit process may be subject to specific provisions of audit mandates, related legislation and regulations. Documentation. Auditor documentation of understanding entities and environment and assessing the risk of material misstatement requesting shall include significant decision reached during the discussion among the engagement teams respected of the entity's financial statement to material misstatement due to fraud. The significant assessing the risk of material misstatement due to fraud at the financial statement level and the assessment level. The auditor and documentation on the response to assess the risk of material misstatement shall include the overall response to assess the risk of material misstatement due to fraud at financial statement level and the nature, timing, extent of audit procedure and linked to those processed and the assess the risk of material misstatement due to the fraud of assessment. The result of this audit procedure including a design to address the risk of management and override the control. Auditor shall document the communication about the fraud made to the management those charged with governance or regulatory others. The auditor has concluded this presumption and the risk of material misstatement due to the fraud relating to the revenue recognition is not applicable. The circumstances of the engagement, the auditor shall document the reason for the conclusion. Mr. Diesel Limited presently engaged in manufacture of fabric. We want to set up a new plant and manufacture a specially kind of fabric provided although different texture feeling. This kind of fabric has become hit and retail customers. Company need to set up a plant for manufacturing above kind of fabric involves huge capital outlays to stay competitive in the market. You are auditor of the companies and find the company's revenue has increased the financial year and 1000 crores from 750 crores as well. But the time you started the audit, there is no change in the plant capacity. Information regarding a need to set up a new plant has become known, and you have inquired the company personally. Discuss how much proceeding to deal with the situation. Auditor of the company paying special attention to the. SA 250 Consideration of law and regulation in the audit of financial statement. SA 250 deals with the auditor's responsibility in considering laws and regulation for performance of audit of financial statement. However, it does not comply with assurance engagement in which auditor is specifically specifically engaged in test and report separately and complaints with specific laws and regulation. These segments of SA is designed to assign the auditors to identify material misstatement of financial statement due to non-compliance with laws or regulation. The effective law and regulation of financial statement of entry. The effective of financial statements law and regulation varies considerably. These laws and regulations which entity is subject to constitute a legal and regulatory framework. The provision of the same law and regulation has a distinct effect of financial statement in which it determines the reported amount and disclosure entity's financial statement. Another law and regulation can be complied with the management set of provisions under the entities is allowed to conduct its business but do not have a direct effect of entity's financial statement.
Some entities operate in heavily regulated industries, such as banking and chemical companies. Others are subject only to the many laws and regulations related to generally to the operating aspect of business, such as those related to accompanying safety and health. Non-compliance of the laws and regulation result of fines, obligation, consequence of entity that may be material effect of financial statement. Objective of auditors according to SC 250. The objective of an auditor, according to SI 250, to obtain significant appropriate audit evidence regarding complaints or provision of law or regulation generally recognized to have direct efforts on the determination of material amounts and disclosures in the financial statements, and perform specific audit procedures to help identify instances of non-compliance with other laws and regulations that may have material effect of financial statements, and to respond appropriately to count complaints or suspected non-compliance with the laws and regulations indicated during the audit. Objective of the auditor to obtain sufficient appropriate audit evidence regarding complaints with the provision of laws and regulations generally recognized to have direct effect on determination of material amounts and disclosures in the financial statements, to perform specific audit procedures to help identify instances of non-compliance with other laws and regulations that may have a material effect on the financial statements, to respond appropriately to non-compliance or suspect of non-compliance with the laws and regulations identified during the audit. Responsibility of the management of compliance with laws and regulations. It is a responsibility of a management with the oversight of the charge with governance GOVERNANC to ensure that the entity's operations are conducted in accordance with the provision of laws and regulations, including complaints with the provision of law regulation that determine the reported amounts and disclosure in the entity's financial statements. Following are examples of types of policies and procedures or entities you may implement to assess the prevention, detection, or non-compliance of laws and regulation. Now, monitoring legal requirement of ensuring operating procedures to design to meet the requirement. In instituting an operation appropriate systems internal control, developing, publishing, enforcing a code of conduct, ensuring employees are properly trained and understand the code of conduct, monitoring policies or conduct a code of conduct, appropriate acting appropriate to discipline employees to fail to comply with it, engaging legal advisors to assess the monitoring legal requirement, maintaining a register of significant laws and regulation which as entity has to comply with the particular industries and records of complaints. In the larger entities, these policies and procedures may be supplied by assessing appropriate responsibility to an internal audit functions, an audit committee and complaints function. The responsibility of auditor. The auditor is not necessarily responsible for prevention of non-compliance. It cannot be expected to detect non-compliance with the law and regulation. The auditor is responsible for obtaining reasonable assurance that the financial statement takes in a whole free or material misstatement, whether caused by fraud and error. In conducting an audit of financial statement, the auditor takes into account of applicable legal and regulation framework. Owing to the inherent limitation of audit, there is an unavoidable risk that some material misstatement in the financial statement may not be detected, even though the audit is appropriately planned and performed by the SC. In the context of laws and regulation, the potential risk of inherent limitation of auditors' ability to detect material misstatement is greater than the reason of the following. There are many laws and regulations related to principle to operating aspecting of entity that typically do not affect the financial statements or not captured by the entity's information systems relevant financial reporting. The non-compliance may involve conducting design to conceal such collusion, forgery, deliberate failure to recover transaction, management override of controls, and intentional misrepresentation being made to the auditor. Therefore, the act constitutes non-compliance is ultimately a matter of legal determination by the court of law. Ordinarily, further moving non-compliance in form of events and transactions reflected in the financial statement, and these likely affect the auditors to become aware of the recognized non-compliance. SA 250 distinguishes auditors' responsibility relating to complaints to different categories, laws and regulations. The provision of the laws and regulations generally recognized to have direct effect on determining the material amount and disclosure in financial statements such as taxes and labor laws. Other laws and regulations that do not have a direct effect on determining the amounts and disclosure in financial statement. When compliance with may be fundamentally operating aspect of business, to an entity ability to continue the business to avoid the material penalty. For example, compliance with the terms of operating license, compliance with regulatory solvency requirement, compliance with the environment regulation, non-compliance with the laws and regulation may therefore have specific material effect of the financial statements. Auditor responsibility relating to compliance with the law and regulation. The responsibility relating to compliance with the laws and regulation generally recognized to have direct effect of determining the material amounts and disclosure of financial statement. The responsibility relating to those laws and regulations that do not have direct effect of determining the amounts and disclosure of financial statement, but their complaints may be fundamentally to or operating aspect of business. For complaints with the provision of law and regulation generally recognized to have direct effect of determining material amounts and disclosures in financial statement, auditor responsibility to obtain sufficient appropriate audit evidence about the complaints of provision through these laws and regulations. In other laws and regulations that do not have direct effect of determining the amount of disclosures in the financial statement, but complaints with may be fundamental to operating aspects of business, and auditor's responsibility limited to undertaking specific audit procedure. Procedure to help identify non-compliance with laws and regulations that may be a material effect of financial statement. Auditor should remain alert in the possible that other audit procedure applied for the purpose of forming an opinion on the financial statement may bring instances of identified or suspected non-compliance in the auditor's attention. To the auditors, and maintain professional skepticism throughout the audit is important to the context are given contents of laws and regulations that affects auditing. Auditors' consideration of compliance with laws and regulation. Part of obtaining consideration of legal entities and environment, auditors shall obtain the consideration, a legal framework and applicable to entities and industry sector of the entity's operation. How this entity is complying with the legal framework. Auditor shall obtain sufficient appropriate audit evidence regarding the compliance with the procedures of laws and regulation, generally recognized to have direct effect on determination material amounts and disclosure in the financial statement, such as laws. For example, some are related to form, content, financial statements, industry specific financial reporting issues. Auditors shall perform the following audit procedures to help identify the instances of non-compliance with other laws and regulations that may be material effect of financial statement. The inquiry of management and those charged those appropriate charged with governance as to whether the entity is compliant with such laws and regulations. Inspecting of correspondence in any of the relevant licensing of regulatory authorities. Certain other laws and regulations need to be particular attention by the auditors because they have fundamental effect of operation of the entity. Non-compliance with the laws and regulations that may fundamentally affect the operation of the entity may cause the entity to cease operation or call into question of entity's continuance of going concern. For example, non-compliance with the regulation of the entity's license and other entitlement to perform the operation could have, say, for example, a bank non-compliance with the capital investment requirement. The NBFC can have leases ceased to carry out the business of the non-banking financial institution if it fails to obtain certificate registration under the RBI Act and if it has a net owned fund is less than the amount specified by the RBI circular. There are also many laws and regulations relating to principally operational aspect of entities that typically do not affect the financial statement and are not captured by the entity's information system regarding the regulation reporting. As a financial reporting consequence of other laws and regulations vary depend upon the entity's operation. The entity procedures are stated above are directed between the auditor's attention instance of non-compliance with the laws and regulations that may be materially affect of financial statement. The auditor procedure applied forms of opinion of financial statement that bring instances of non-compliance and suspected of non-compliance with laws and regulation to the auditor's attention. During the audit, auditor shall remain alert to the possibility that other procedures applied may bring instances of non-compliance or suspectability of non-compliance with laws and regulations to auditor's attention. Auditor shall request management that appropriate charge of the governance to provide the written representation of all the instances of non-compliance and suspected of non-compliance of laws and regulations. The effect could be considered when preparing the financial statement when have disclosed to the auditors. Audit procedure when non-compliance is identified or as suspected. If auditor became aware of information concealing instance of non-compliance or suspected of non-compliance with the laws and regulation, auditor shall obtain understanding of the nature of the act and circumstances in which it has occurred and further information to evaluate the possible effect on financial statements. If an auditor suspects there may be non-compliance, auditor shall discuss the matter with the management and where appropriate, those charged with the government. If the management has an appropriate, those charged with the government do not provide sufficient information support the entities in compliance with laws and regulation, audit judgment affects the suspectability of non-compliance may material to grant statement. Auditor shall consider the need to obtain legal advice. If sufficient information about suspect of non-compliance cannot be obtained, auditor shall evaluate the effect of lack of sufficient appropriate audit evidence and auditor opinion. Auditor shall evaluate the implication of non-compliance regarding the other aspect of audit, including the auditor's risk assessment and reliability of written representation and risk appropriate actions. Reporting identify a suspect of non-compliance. Reporting non-compliant to those charged with governance. Unless all those charged with governance are involved in management of entity, therefore be aware of the matter involving identifying of suspected non-compliance already communicated by the manager. Auditor shall communicate to those charged with governance matter involving non-compliance with laws and regulation that comes to the auditor's attention during the course of audit, other than when the matter of clearly inconsequential. If the auditor's judgment on non-compliance refer to the believed to be intention and material, auditor shall communicate to the matter to charge with governance as soon as possible. If the auditor suspect the management, those charged with governance or involved in non-compliance, auditor shall communicate the matter to the next higher level of authority at the entity if it exists, such as the audit committee or supervisory board. There is no higher authority, or if the auditors believe to be communication may not be acted upon to ensure the person to whom report, auditor shall consider the need to obtain legal advices. Reporting of non-compliance of auditors report of financial statements. If the auditor concludes the non-compliance or material effect of financial statement has not adequately reflected a financial statement, the auditor shall subject as if an express and qualified adverse opinion on financial statements. If auditor is precluded by the management or those charged with government obtaining sufficient appropriate audit evidence to evaluate whether non-compliance that may be material to financial statement has or likely to be have occurred, auditor shall express a qualified opinion or describe the opinion of financial statement and based on the limitation of scope of the audit according to SA 705. If the auditor is unable to determine whether the non-compliance occurred because of the limitation imposed by the circumstances rather than by management on those charged with governance, the auditor shall evaluate the effect of the audit opinion under section 705. Reporting non-compliance regulatory enforced authorities. If auditor has identified the suspect of non-compliance with laws and regulation, auditor shall determine whether the auditor has responsibility to report the identified suspect of non-compliance with parties outside the entities. Documentation. Auditor shall document identify suspectable non-compliance with laws and regulations and the result of discussion with management will supplement charge the governance and other parties of entities. FAS Insurance Broker Limited lending online insurance enterprise. During the year, Director General of GEGI has issued a notice of company violating creating fictitious invoice or marketing and sales invoices among 50 crores in favor of non-life insurance company. The premises of company were also searched during the year of DGGI official. The matter may be informed to IRDAI, DGGI in violation of the norms and regulation of the regard. And thus above situation to be bearing on our responsibility to situation and to take auditor of the company. Outline brief context of possibility of non-compliance with laws and regulation. SA 260 communication with those charged with governance. SA 260 dealing with the auditor's responsibility communicate with those charged with governance in the audit of interest statement. Who are those charged with governance? Those are who charged with governance in the person, the organization whose responsibility of overseeing strategic direction of the entity's obligation and regarding to the accountability of the entity. This include overseeing the financial reporting for some entities. As those charged with governance may include management person. For example, exclude the members of the governance board and private public sector entities or owner manager. Government structures may be entities reflecting influence of different cultures and legal background, size, and ownership category. For example, some entities supervise board exist that are separate from executive board. For instance, supervisory and executive functions are performed by a single board. For some instances, the entities, the function of the government holds position of the integral part of the entity's legal structure. For example, the company directors in some cases show some of them charged with governance involves managing of entities. In other, those charged with governance and management comprise different persons. In more entities, government is in the collective responsibility of government bodies, such as boards, directors, supervisory boards, partners, proprietors, committee of the management, trustees, equivalent person. In some small entities, however, one person may be charged with the governance. For example, owner, manager, those charged with owners and sole trustee. Some diverse means it's not possible to specify all the duty of the audit of this person whom auditor is communicate with particular matter. All these cases, appropriate charge with governance communicate may not be clearly identified. Then it's applicable legal framework and other engagement circumstances. For example, entities whose governance structure is not formally defined, such as family-owned entities, some non-profit organization. In this case, auditor need to discuss, agree with the engaging party to relevant person to whom to communicate. Deciding whom to communicate. Auditors engage the entities, governance structures, and process to obtain according SA 315 relevant appropriate person to whom communicate may dependent upon the matter to be communicated. Significance of communication to those charged with governance. Communication from the auditors are important to those charged with governance. The effective two-way communication is important in assisting the auditor and those charged with governance, understanding the matter related to the audit and contents, and the developing in constructive working relationship. Relationship is developed while maintaining the auditor's independence and objectivity. Auditor is obtained from the like charged with governance information relevant to the audit. For example, those charged with governance may assist the auditor to undertaking the entities in the environment and identifying the appropriate source of the audit evidence and providing information about specific transaction events. Those charged with the governance fulfill the responsibility to oversee the financial reporting process, thereby reducing the risk of material misstatement in financial statement. Objective of an auditor in respect to SA 260. The objective of auditors are to communicate clearly with those charged with the governance, responsibility of the auditor in relation to the financial statement audit, and overview of planned scope of timing audit, to obtain from those charged with governance important relevant of the audit, to provide those charged with governance timely observance arising from the audit that are significant relevant to the responsibility to oversee the financial reporting process, to promote effective two-way communication between auditor and those charged with governance. Objective of auditor to communicate clearly with those charged with the governance and responsibility of the auditor in relation to the financial statement audit and the overview of planned scope and timing of the audit, to obtain those charged with the governance information relevant to the audit, to proceed with those charged with the governance, the timely observation arising from the audit of significant relevant to the responsibility and oversee the financial reporting process, and to promote effective two-way communication between the auditor and those charged with governance. Determine the appropriate person to whom to communicate. Auditor shall determine the appropriate person with the entities at government structure to whom to communicate. The matters to communicate by the auditors. Following matters are required to be communicated by the auditor with the charged with governance. Auditor's responsibility to regarding the financial statement on. Auditor shall communicate with those charged with governance. Responsibility of auditor relation to the financial statement of audit, with including that auditor is responsible for forming and expressing an opinion and a statement that are prepared by the management oversight of charge with governance. Audit of financial statement does not really manage and charge with governance from responsibility. The auditor responsibility to financial statement. Auditors often involve the engagement letter and other suitable form of written agreement relating to agreed terms of engagement law. A law regulation of the governance structure. Entities may require charge with the governance and to agree in terms of engagement of the auditor. With this not the case, providing charge with governance with a copy of engagement letter or a suitable form written arrangement that are appropriate to be communicated. Planned scope and timing of audit. Communicate regarding the planned scope and timing of audit may be assess those charged with governance to understand the better consequence of auditor's work, to discuss the issue, to risk and concept of materiality with auditor, to identifying the areas in which may request auditor to understand the additional procedures, unless the auditor to understand better the entities and environment. Auditor shall communicate with those charged with governance, overview of the planned scope and timing of audit, which includes communication of significant risk and identified by the auditor. Communicating significant risk identified by the auditor. Keep those charged with the governance and understand this matters, and that's why required special audit consideration. This communication about significant risk may consist this as charged with governance and following the responsibility to overseas financial reporting. While communicating those charged with governance may assist the auditors to plan the scope of timing of audit, it does not change in the auditor's role, proper responsibility, establish audit overall strategy and audit team, including nature, timing, extent of procedures necessary to obtain significant appropriate audit evidence. The care is necessary to communicate with those charged with governance about the plan, the scope, and timing of audit so as to not to compromise the effectiveness of audit, particularly where some all of these charges governance involves managing the entity. For example, communicating the nature, timing, and details of audit procedures may reduce the effectiveness of the procedures to make them too predictable. Significant finding of the audit. Auditor shall communicate to social governance or a view about the significant quality aspect of entities, accounting practice, including accounting policies, accounting estimate, and financial statements and disclosures. When applicable, auditor shall explain to those as governance by the auditor and consider the significant accounting practice that is acceptable under the applicable financial reporting framework, not to be most appropriate in apparent some particular circumstances of the entity. Significant difficulty, if any, encountering the audit unless there is a co-character charge with governance involved in the managing entity. A significant matter arising during the audit that is disclosed and subject to corresponding management return representation of the auditors and requesting the circumstances that affects the forms and contents of an auditor's report, if any of the significant matter arising from the audit that is auditor's professional judgment are relevant to the oversight of financial reporting from the communication finding. This audit may involve request further information from those charged governance in order to complete the audit evidence begin. For example, the auditor may confirm that those charged with governance may have the same understanding of the facts and circumstances relevant to specific transactions event. Significant difficulties encountered during the audit may include a matter significant delays in the management and unavailability of entities, person entities, and willingness to manage to provide information necessary for the auditor to perform the audit procedure, and reasonable brief time within which to complete the audit, extensive and unexpected effort required to obtain significant appropriate audit evidence to unavailability of expected information, restriction imposes on the auditor by management unwilling to make an extended assessment of the entity's ability to continue as an own consensus process. Significant matter that are discussed to subject to the correspondence of management may be included following segments. Significant events and transactions occurs during the year. The business conditions affecting the entity's business plans and strategies that may affect the risk of material misstatement. Concerns about management consultation and with other accountants and on accounting and audit matters. Discussion of correspondence in connection with the initial recurring appointment of the auditors regarding accounting practices, the applicability of accounting standards, or fees of audit serves a significant matter in which the disagreement with the management expected for initial differences of opinion because of incomplete facts or preliminary information that is later resolved in auditors obtaining additional relevant fact of information. The agreed terms of audit engagements required to be recorded in audit engagement letter. Another suitable form of written agreement include, among the other things, reference to the expected forms and contents of audit report, communication with the source charged with intention, inform the manager charged with the governance of accounts in which auditor's report may differ from the expected forms and contents may include additional information about the audit data performed. Circumstances in which auditor is required or any otherwise considered necessary for including additional information in auditor's report in accordance with the SC. Others communicate with charge of governance required including the auditors expect to modify the opinion in the auditor's report in accordance with SC 705 material uncertainty related to going concern report according to SC 705 key audit matters communicate with SC 5701. The auditor considers necessary to include emphasis of matter para other key matter para SC 706 required under SC auditing. The auditor should conclude that the uncorrected misstatement of other information upon SC 702. In this comes the auditor may conclude useful provided that they charge with governance, a draft auditor's report facilitate the discussion how such matters can discuss in the auditor report. Communication auditors independent in the case of lesser entities. In the case of lesser entities, auditors are communicated to those are charged with governance. And then the statement that the engagement teams in other firms or appropriate firms are applicable. Network firms as a complaint to the relevant ethical requirement regarding the independence. All relationship and other matter between the firms, network firms, and entities that as an auditor's professional judgment may reasonable by through beer of independence. This shall include total fees charged during the period covered by the financial statement for the audit and non-audit services provided by the firms and network firms to entities and components are controlled by the entity. The fee shall be allotted to category these appropriate to assess those charged with the governance, assessing the effect of services on independent of the auditor. Right and safeguard that may be applied, eliminate the identified threats and independence or reduce the risk to acceptable level. Communication process. The auditor shall communicate with those charged with governance and form time and expected to general content and communication. Auditor shall communicate in the writing with those charged with governance regarding significant finding from that audit. If an auditor's professional judgment overall communication would not be adequate, written communication need not include all the matter that arouse in course of audit. Auditor shall communicate in return with those charged with governance regarding auditor's independence when required in case of listed entities. Auditor shall communicate with those charged with governance on timely basis. Adequacy of communication process. Auditor shall evaluate whether two-way communication between auditor those charged with governance may be adequate for the purpose of audit. If it is not, auditor shall evaluate the effect if any auditor's assessment and risk of material misstatement, ability to obtain sufficient appropriate audit evidence shall be taken precaution. Documentation. During where matter require SA 260 communicating the communication orally, auditor shall include them document then when whom communicated where the matter has been communicated and written. Auditor shall retain a copy of communication a part of audit documentation. SA 299 joint audit of financial statement. CA Baba Sundar, auditor of the leading private sector bank IT system and control in under his concentration. The required key audit matters audit reports due high level automation complexity of IT and impact of want to communicate and key audit matters. What is the relevant consideration regarding the usefulness? Okay. Two joint document audit of financial statement. SA 299 lays on the principal effective conduct of joint audit, achieving the overall objective of audit laid on SA 200 and deals with specific consideration carrying out the audit joint. However, it does not deal with the relationship between the principal auditor who is appointed to report on the financial statements or entities, another auditor to appoint in the report the financial statement, two or more components, division, branches, subsidiaries, joint venture, associates, and which include financial statements of entity. What is a joint audit of financial statements? Joint audit of financial statements are audit of two or more audit appointing objective issue audit. Some auditors are described as an audit approach. Joint auditors. The practice of appointment more than one auditor to conduct the audit of large entities has been worked for a long time, sometimes voluntary by the shareholders, sometimes due to the requirement of law and regulation. Some auditors known as joint entities but conduct an audit jointly and report a financial statement entities. For example, SA 3 three companies have provided members of the company may resolve to provide the audit shall be conducted more than one auditor. Objective according SA 299. Objective according SA 299 another lays down the broad principles of joint audit and conducting joint audit. The provides uniform approach to process of joint audit. Identify the distinct area of work coverage therein such joint auditors and identify the responsibility of joint auditors and joint auditors relation to it. Objective of auditor lay down the broad principle of joint audit and conducting joint audit to provision uniform approach to the process of joint audit. Identify the distinct area of work and coverage therein such audit. Identify the individual responsibility of joint auditors and joint auditors relation to audit. Audit planning, risk assessment, and allocation of work. The engagement partners, other key members of the engagement team in which joint auditor shall involve planning and audit. Overall audit strategy, set up the process, scope, timing, direction of audit, and guide to develop the audit plan shall be established only. Prior to the commencement of audit, joint auditors can discuss the following joint audit programs and developing joint audit plans, and joint auditors shall identify the deviation of audit areas and communicate their audit areas. And against a joint auditor that defines the scope of an audit in each joint auditor. Our joint auditors are appointed. They should be mutual discussion. Divide an audit work among themselves and division of work would usually terms of audit identify the user specific areas. Some of the cases due to the nature of interaction business and entities using entities in the division of your work may not be possible. In this case, division of work may be referred in terms of assets and liability, income and expense, certain areas of work owing to the importance of owing to the nature of work and is often be divided into cover all joint ventures. Assertion of responsibility. Assertion responsibility of engagement plan, timing and audit of a nature of communicate required. Whether the communication among all joint auditors, there is a professional judgment, significant directive engagement teams effort. Considering the result of preliminary engagement activities, whereas an applicable knowledge gained from a similar engagement performs earlier by the respective engagement partner of the entities relevant. Ascertain the nature, timing, extent of the resources necessary to perform engagement. At the stage, the risk of material misstatement need to be considered. The assessment of each of the audit joint auditor shall be communicated in each audit auditors and document whether pertaining to overall financial statement level and area of allocation among the joint auditors. Joint auditors shall discuss the document as nature, timing, extent of the audit procedure. Or common specific audit area and to be performed such joint auditors and some of them communicate those charges counts. Joint auditor shall obtain common engagement letters and common management representation letter. After identification of allocation of work among joint auditors, a work of allocation of document shall be assigned by joint auditors and same shall be communicated with the charges governance or entity. The documentation of allocation of work helps the avoidance of disputes and confusion which may arise among joint auditors regarding the scope of work to be carried out them. Further, the communication of allocation of work to be entities keep avoiding may dispute confusion with those arising between the entities and joint auditors. Responsibility of coordination among joint auditors. The joint auditors obtain evaluation information explanation from the management responsible for sharing of all joint audit work unless agreeing upon specific patterns or distribution of responsibility. In case of joint audit work divided among joint auditors, and each joint auditor shall be responsible only for the work allocated in each joint auditors, including proper execution of work procedures in case of specific division, zones and unit allotted in different joint auditors in that. The separate specific responsibility for responsibilities in the management joint audit obtain information about the explanation from the management respect of the division zones unit evaluation information and explanations obtained from the joint auditors. Joint auditors shall have proper coordination and rationale among members. All the joint auditors should be joint and several responsible for the audit work which is not divided among the joint auditors carry about by the all joint auditors. This decision taken by joint auditors under the audit planning in respect of the common audit areas concerning the nature, timing, extent of audit procedure to be performed in each audit joint auditors. Matter which is brought a notice of joint auditors by one of them and one of which is agreed among the joint auditors. Examine the financial statements of entities comply with the requirement of the relevant statute. Presentation, disclosure of financial statements are required by the applicable financial reporting framework, ensuring that audit report complies with the requirement of relevant statute, the applicable standard of auditing on other relevant procedures issued by ICAI. Whether the where in the course of audit joint auditor comes across a matter which is relevant to the area of responsibility and other joint auditors which is deserved their attention, which require disclosure to be required discussion in applicable application of judgment of other joint auditors. Said joint auditor shall communicate the same to all the joint auditors written prior to the completion of the audit. He shall be responsible for each joint auditor determine the nature, timing, extent of audit procedure to apply to relation to the area of work allocated in the joint auditors. It is individual responsibility of each joint auditor study and evaluate the prevalent system of internal control, assess the risk of areas of work allocated on joint auditors. As regarding the decision taken by the joint auditors, the audit planning in respect of common areas concerning nature, timing, extent of audit procedures to perform by each of the joint auditors. All these joint auditors are responsible for only the appropriateness of decision concerning nature, timing, extent of audit procedure agreed upon them. The proper execution of audit procedures individually responsible for the joint audit concern.